We have a couple of questions that were submitted, but I might open up to the floor first if anyone has any questions they want to ask. Please.
Yeah. That was intellectual property talking about that you've invested in.
Yeah, it's a copyright. It's essentially a type of copyright, yeah.
Why not some hard property like vinyl? It's going up.
Yeah, well, that's the revenues from, I mean, your vinyl's had kind of a comeback. Yeah. So I guess the key thing for us is we'll buy anything if we can buy it cheap enough. So we like this because it's an interesting asset class, but why we buy it is because we're buying it at 50 cents in the dollar. So we're buying these assets much, much cheaper than their fair value.
It's pretty hard to buy a record store.
It is, I mean, and you got to worry about, you know, hit.
Yeah, it is. Well, some kids do.
Cheers. Did you have one?
I was just going to ask, where do you see yourselves in 10 or 20 years? It's still going to be standing up there?
Yeah, definitely. If you'll have us. I mean, I think we've kind of gone through, as Emma said, we've gone through this big growth spurt. And I think we've got the team now where we want it. We don't need any more managers. We'd like GVF to be a little bit bigger. We've launched a second fund, which is sort of slowly growing to the size we want it to be at. But I'm determined to do this until you guys tell me to shove off. So we're not going anywhere in a hurry.
I feel the same. I feel like we've built, it's been 9 years. I can hardly believe it, but it's been 9 years, and we really love it. I really have a lot of satisfaction from this work, and I know Miles, he's really quite good at it, and I think he really enjoys it. And the team that we've got, we're not massive fans of, we're not going to build a huge empire. I'd be surprised if we hire maybe 1 or 2 more people in the team over the next 2 decades at most. We have a tight-knit team. We like working with the people that we work with. Miles and I get back to London quite frequently. We both go back at least every 3 months on alternate schedules. So that's also very important because, of course, we've spent so much time in London. I love that.
You did start off in
Yeah.
Of course, yeah.
And most of the team is still there. So,
the whole, exactly. It's a London business, essentially. And we are working remotely for that London business, if you like. Exactly. And to bring our kids up in, let's be honest, possibly the best country in the world. So, yeah, for as long as you will have us. But under no illusions that if things change, you know, we understand and we'll move with that.
Get into music.
Please.
A question about the music royalties. When you say, so for example, Ed Sheeran writes his own songs.
Yeah.
They own, when they sell that, they get it at a premium. But if they bought a song that's written by a third party, is that then shared between? How does that work?
Yeah, it's really interesting because a lot of music now is very manufactured. Like most of the pop songs you hear on the radio are not Ed Sheeran. You've got a team of guys writing lyrics, you've got a team of guys composing music, then a production thing that goes all around it. So the rights, I don't have a clean answer for you other than to say each situation is different. But in that situation, the most valuable thing is normally the master recording. So they'll all come together, make one sort of iconic version of the song, and that's the thing that gets played on the radio or on Spotify.
Whatever that royalty gets shared between however many people are involved.
Exactly, or unless someone like us comes along and buys it. And it's a really interesting industry, not to sort of geek out on it too much, but it's one where the buyers of these assets can actually add a lot of value. So when Hypnosis Song buys a catalogue from Beyonce, the first thing they do is they've got their salesman out there with sharp elbows and they're trying to make sure that her songs are in the next Revlon commercial or the next James Bond movie. So it's sort of a situation where a financial owner can sort of create more value than the more valuable. Exactly, or used in like commercials and things, all that kind of stuff.
Or get some younger singer to cover it, you know, like so many of the Elvis songs, for example, or covering those sorts of, so appealing to the next generation with older songs is a smart play.
And you know, Ed Sheeran is not going to chase Revlon to get the next kind of commercial deal, but a guy in a suit will happily do it.
They're sort of a marketing company.
In a way, yeah, marketing company.
Does the artist generally hold a percentage of himself, or do they normally sell 100%?
It's normally the whole thing, but there's everything's a little bit bespoke, and they're often, these negotiations, as Hypnosis would say, these negotiations are very sensitive. There's a lot of caveats around protecting the legacy of the work. Like Ed Sheeran doesn't want his songs played for like a nuclear bomb firm, I'm making it up, but like for an arms manufacturer or something. So there's a lot of caveats around it. But in the realm of sensibleness, then we essentially own the rights. And it's a big payday for them. So I mean, someone like Justin Bieber recently sold his catalogue for I think 300 million, or a huge number. But it lets him kind of monetize everything now, not have to wait till he's 60, and he can, start again and do something totally new. And invest his money in GVF, as he should be. Yeah, exactly.
I'm sure that's what he's doing.
They thought about doing the same thing like monarchs, car shows, where they sort of never realise anything till they're actually in the green.
Yeah.
Exactly.
Yeah. It'd be a bit like selling it to a museum, I guess, and the museum earns revenue from selling tickets. It's a similar sort of concept. But, yeah. So I'll come back, Jake. Yeah, so I mean, just to sort of talk about the philosophy of that, we run with a relatively low-risk portfolio. We don't own a big basket of shares that bounce up and down, if you remember the chart. So against that sort of low-risk proposition, I'm generally happy to run a little bit of leverage that boosts the returns a little bit, and we aim to run at about 5 to 10% levered, and right now we're about 5%, which is where we normally sit. Yeah.
So if you invest in this kind of activity, you have to sell something off.
Yes. I mean, one of the features of the portfolio is we constantly have realizations and trading opportunities coming and going. But, I mean, one of the things that I like to use leverage for, one of the advantages, we'll probably get onto this, but LICs have had a bit of a beating in the press recently. One of the advantages of a LIC is that you can use leverage and you don't have to perfectly match buys and sells. So if we find something that's suddenly super cheap, there's been a big sell-off in the market, I don't have to go and sell something to free cash up to buy it. I can buy it, use a little bit of gearing, and then wait over the next month or two for an appropriate time to sell to match it off again. Yeah. Jane.
You mentioned you wouldn't mind growing the business a bit more. So for GVF, would that involve raise of some sort, and also what would be your ideal size of business across both funds?
Yeah. So I think we were on record as saying we want to get GVF up to about 300, but no bigger. And we will only ever do that if GVF's trading at a premium. At the moment, we're at a bit of a discount, so a bit cheap. And we'd only do that if there's real demand. So if no one wants to give us more money, that's life, that's fine. But over 9 years, I think we've done 6 or 7 capital raisings when we've been at a premium. So if we were to get back to a premium, we've probably got 1 or 2 more capital raisings ahead of us before we get to the point where we say we're about the right size. We also have our second fund, which is going now and is about 30 million US in it, or about 50 million Australian. And we don't really want that to get much more than 100. So we're well past kind of the halfway point of what we want to grow to as a business. And as Emma was saying, we kind of invested in the management of that first. So we've got a big, heavy team, and hopefully we can grow AUM a little bit to sort of match that over the next few years. But we're in no rush. We'll just get there when we get there.
Just another question. So you mentioned also the LIC structures being on the
Yeah.
And we've just seen Jeff Wilson for the first time, I think, offer
Yeah.
different structure. So I'm just interested in your thoughts on LIC, the sector generally.
Yeah.
Actually, that was a question as well from David Elliott. He said the exact same thing as you, Jane,
Well, let me repeat the question just for the mic. But
Okay.
So the question, to paraphrase, the LIC sector in Australia has been under a lot of pressure recently. And then we've seen Jeff Wilson, kind of the grandfather of LICs in Australia, launch an open-ended
I don't know
fund.
if he'd like grandfather.
Okay, well,
Let's go with
the
father.
mentor. Launch an open-ended fund, which he's never done before. Does this all ring the bell for the end of LICs? That's probably a fair synopsis. Well, to start with Jeff first, we know the guys at WAM really, really well. And if I rewind back to 5 years ago, when they brought WAM leaders to the market, I'll be honest, I and a lot of people were quite sceptical. Like, it's hard to outperform big cap stocks in Australia by stock picking. Most of the research says it's basically impossible. Fast forward to today, and Matthew Halp has done a tremendous job there. It's been a tremendous success, and they've raised a lot of money into that strategy. And I think, and you should ask Jeff these questions, I'm just kind of giving my observations, but my understanding is that it's unusually for the kind of things that interesting fund managers do, it's a very scalable strategy. Like in our strategy, we could never run billions of dollars doing what we do. But in large cap ASX stocks, you literally could run billions and billions of dollars. So I think from them, it's just a business point of view. There's lots of potential investors out there that don't want to invest in LICs for a whole host of reasons, often because they want to put much bigger amounts of money to work. If you're an institution and you want to put $50 million with Matthew Haupt, you can't really buy and sell that on the ASX. So my understanding is not that Jeff's given up on LICs, it's just that he's got a product that's doing really well and he's trying to open it up to a different investor base. But you should definitely ask Jeff that, not me. And in terms of LICs in general, I mean, it's fascinating to watch, and it's actually part of our business model. These structures come and go out of favour all around the world all of the time. I was saying earlier before, you know, the very first closed-end fund was set up in the 1800s. So these things have been around for 200 plus years, and they were set up to fund the development of the US railways. You remember that whole story of British money going in, building the railways in the US? A lot of them blew up, some of them succeeded. And as a structure, it's constantly reinvented itself, and it's gone through bursts of hyper excitement and big despair. If I look here in Australia, I think there was a big wave of new LICs that came to market 4 or 5 years ago. And unfortunately, without kind of, you know, throwing shade at any competitors or anything like that, I'd say a good portion of them didn't live up to what they said they'd do on the tin. And because of that, they've traded at discount. So I think part of the discount problem we're seeing at the moment is not so much people giving up on LICs, it's just that there's a number of managers where they haven't performed the way that they promised shareholders they would, and performance is what generates the best rating over time.
It's also possible that the raisings were too big.
And there's possibly a case of rationalisation where too much money came in, and just like I showed with the Roundhill example, where people get too despondent the other side of the equation.
And at the end of the day, a discount is there because there are more sellers than buyers.
Yeah.
So I think it could be a combination of that as well, and it's natural in the cycle for that to kind of balance out.
Yeah, but if you look at some of the LICs like PM Capital, PGF, they've done a tremendous job recently trading at a premium. I'd like to think we've done a pretty good job over a long period of time. We've never had a big discount problem. So I think the places where you're seeing the discount problems, it's perhaps not so much a LIC problem as it is the product is just not doing what it promised it would do. And then separately, that, you know, you have a big period of probably too much money raised. You need to have a rationalisation period, and the number of options shrink. Hopefully the ratings get a bit better. For us, it's wonderful. I mean, we invest in discounted LICs. That's basically our business. So we've had a field day here in Australia recently. You know, one of our biggest investments, which we're on public record as saying, is in Magellan, MGF. And some of you might have seen that yesterday they announced that they were going to convert that into an ETF. So that was the biggest investment in GVF. We owned it at a wider than a 20 discount, and we're going to get out at parity sometime next year. It's been a tremendous investment.
And again, tremendous investment because the underlying there were large US
listed
shares,
stocks that have participated in the rally that I was just talking about.
Yeah.
There's a number of other names we're very actively involved in, but we're not public about it, so I won't talk about it. But I would say it's far too soon to give up on LICs. And even in an Australian setting, you look at things like AFIC and Argo. They have been through dozens of cycles in their 60, 70-year history. So we'll watch this space, but I think it's a bit early to say it's the end of the day for them. Yeah, g'day.
Sort of a strange question, perhaps. But, I know you're worried about inflation.
Yeah.
Do you think that inflation, when we get back to anything of 2 to 3%?
Yeah.
Now, I'll give you an example where I don't think it's. My first ever investment was a house in Brisbane, right? A friend and I bought it for $60,000.
Wow.
We were getting 9%.
As a rental yield?
Now I'm talking about in 1980 something.
Yeah. Wow.
But the return on a house at that time was about 9%.
Yeah.
These days, people are going out and buying houses and accepting yields of gross 3-4%.
When inflation's at 6. Yeah.
Now, isn't perhaps the inflation we're seeing is a return to the median rather than inflation?
Yeah. It's like the key issue in finance at the moment. So the question from the gentleman was, you know, how do we see inflation panning out in the future? Is higher inflation today perhaps just a return to the median, or much higher inflation in times gone by. It's an impossible question to answer, but it's a really fascinating question, and the answer will drive what markets do over the next sort of decade. I guess on one side of the argument you have, we've just been through this period where China got integrated into the global economy, Eastern Europe got integrated into the global economy, you've had a big boom in global trade, and it's suppressed prices of things for a long period of time. The argument that inflation is not going to go away is that the China phenomenon is now going to reverse. You've got a much older workforce everywhere today, so you've got less workers producing the same amount of food or things to buy. And you can make a case that inflation needs to be structurally higher. The problem is people have been making that argument for the last 10 years, and pre-COVID it was tremendously wrong. So I don't know how it's going to pan out, but I guess what I think and how we sort of position the portfolio a little bit is there's so much credibility on the line for central banks to get inflation back down. I think they will keep going at the expense of pushing us into recession, which is the thing that worries me a bit. And I also think that getting inflation down from, say, the last percent or so, getting it from 3 down to 2 is going to be the really hard work. I think getting it down from the high figures down to sort of 3, 4 is going to be much easier than squeezing it from 3 to 2. And unless they give up on their commitment to that number, I do think we're going to have some economic pain. Like, they can't let inflation keep rolling along like it is. But if I knew the answer, we'd be doing very well.
We had another question from one of our shareholders, and it was around the discount that GVF is currently trading at. And I thought I might just talk a little bit to that. So GVF, since our IPO in 2014, 9 years ago, the average discount premium that we've traded at on a monthly average basis has been around 2% discount. So we've always traded very close to the NTA. At the moment, we're trading at about a 6-7% discount. And there's two reasons we think for that. The first is we have a large shareholder who has to sell quite a bit of the shares and has been sitting in the screen, getting that out slowly. So that's the first thing. And then the second thing, and this is something that Miles and I feel so strongly about, we definitely think that there's a very strong correlation between us marketing. So what we've seen historically over the last 9 years is when we go on the road and see investors, we tend to see our share price go to a premium at the end of our road shows, and then it kind of holds us for the whole year that we're still in London, and then we come back round a year later and it's at a small discount again, and we hopefully push it back into that positive space. With having our third child, we haven't been marketing for more than a year and a half, and we've just seen that discount kind of creep in. But we are, working on getting it out and getting us back up to that.
Back on the old schedule now. So,
exactly.
And hopefully a better schedule. Part of the reason for coming back to Australia was instead of trying to do one mad marketing trip every year, we can do a lot more. We can see a lot more people. Yeah. We've had to turn down in the past all these wonderful invitations to speak at ASA events and things like that, just because the time zone makes it impossible to meet people out here.
Exactly. So hopefully we're going to spend a lot more time doing that, and we've had a really kind of positive reaction in this roadshow. I think we're a week in, so I got another 3 weeks to go, 3 or 4 weeks to go. But yeah, I just wanted to address that, because if you do see us, at the moment we are trading at about a 6-7 discount, and that's quite rare for us.
As Jeff Wilson would say, bargain.
A bargain. That's true.
G'day.
I know how to get rid of your discount.
Oh yeah?
Tell me.
Just keep raising the dividends.
Yeah, I know.
Yes. Well, we could actually.
Well, do you mind jumping back to the to the chessboard slide? So on the dividends, we have this kind of discussion at a board level a lot, and there's clearly a lot of shareholders that want the dividend to be as high as possible. I guess the things that go into this dividend discussion are, we've generated returns of nearly 11% per annum, and we pay out about 8%. So we're paying out about 80% of what we make. There's still probably a minority, but not a tiny minority. There's a reasonable cohort of shareholders that say they would like us to pay a lower dividend because they'd like the share price to go up. So we can't do both. If we generate 10% return, we can either hang on to it, which will increase the NTA, which should increase the share price, or we can pay it all out. And there is a sort of nuance, theoretically, you pay a slightly lower tax rate on capital gains than you do on dividend income. So those are the things that go into the equation. I guess what I try and say to people is that paying out 80+% of what we earn, we're definitely in the camp of we're going to pay most of it out. But it's not an easy decision to make. All I can do is focus on the return number, and then we can sort of carve
Divvy
up the
up
pie
that.
as we do. But
Fully franked.
yeah, yeah.
Don't ever lose that.
Yeah, we're doing our best.
What?
Yeah,
I live on it.
I know.
No,
So many people
I know,
do. We know
I
how important it is.
But you know, we are an international company, and we are investing internationally. So we don't get franking from our investments. But obviously, Miles will just keep doing positive investment returns, and we'll just keep paying the ATO tax to get franking. So it's no problem.
I've been since the IPO.
Have you? Wonderful.
Yes, I know.
Stop.
Thank you.
If it ever comes to that, and we have partially franked dividends in the past, as you'll know, we'll just increase the dividend to make up for it, the cash dividend.
I should say the board will increase the
The
dividend.
board, not me. I mean, I have no say, but the board, yes. As you can see, our directors there on the screen. Perfect. Does anyone
call
have
it a
any
wrap?
questions, or should we go and have?
We're here, obviously, but I think we get some cake and stuff.
Your
Yeah.
other fund you've started,
Yeah.
what is it and how's it performing
Yeah.
compared to global?
Oh yeah,
Yeah,
great question.
great question, actually. So, I mean, and just to talk a little bit about that. So, we wanted to launch a second product for institutions. So, again, like I was talking about with Matthew Halp, it's hard for large institutions to put a lot of money into GVF. There's just not the liquidity. And at my previous firm was a hedge fund in London. We used to manage money for sort of large endowment funds around the world. So we set up a structure for those types of investors. Unfortunately, it's not a very user-friendly structure for retail investors in Australia. It's a Cayman Island structure. It's denominated in US dollars. The minimum investment is $2 million. So it's sort of it's for wholesale, and legally we can only take wholesale investors into it. But apart from that, it's very similar to GVF. Its returns have been quite good since we've launched. We're really proud of that, touch wood. It has
So
a
much
slight,
wood.
so it shares all the same investments. It's a smaller fund. And it has a slightly higher risk and reward kind of profile because the institutions have longer investment horizons. Some of these institutions are investing for the next sort of 20, 30, 50 years, whereas I think a lot of people in GVF are in retirement phase, have sort of got half an eye on can't suffer a big drawdown in the near term. So in the new fund, we use a little bit more leverage. We sort of push the boat out, not enormously, but a bit more. And hopefully over time, that should mean slightly higher returns than GVF, but a more bouncy ride along the way.
It's identical to GVF except for, so same fees, same everything, except for it's US dollar denominated, 2 million minimum, and doesn't pay anything out. So it's a massive accumulation. Yeah, it doesn't pay any dividends or anything like that. It's those institutions. They don't really want them, no, especially the longer term investors. Exactly. Exactly. So we wanted to kind of diversify Starter Capital a little bit and just have two types.
GBS invested, we as shareholders of GBS actually invested in that.
Oh, no. They're both
They're both separate funds.
You don't.
No, we can't invest in each other's funds.
No.
So
No.
when we buy $100 worth of Hypnosis Song, we'll probably put 80 in GVF because it's a bigger fund, and we'll put 20 in the
It's
new
all
fund.
pro-rated on a pro-rata basis, yeah. So yeah, it's...
Touch wood, it seems to be going okay. Cool. Well, we're still here, guys. I think there's some
Yes,
we have
we've
some
got
drinks
some-
and tea, so we can keep
some
chatting
snacks,
outside if you like.
hopefully.
And thank you very much. Thanks
Thank
for coming
you.
along. Really appreciate
Thanks,
it.
guys.
Oh, thank you.